The MLP business structure was enabled by Congress about 25 years ago to foster U.S. domestic energy independence. Today, there are about 75 publicly traded MLPs, many of which are traded on the New York Stock Exchange. MLPs report quarterly just like corporations. MLPs pay their distributions or dividends quarterly just like corporations. And the dividends for MLPs are more precisely called distributions. MLPs are not highly correlated to the S&P 500, nor to the bond market, nor to commodities. And this unique non-correlation feature adds diversification. The balance sheets of MLPs are utility-like, namely about 45% debt to cap. The modern day MLPs date back to the late 1990s, and when they first started traded, we first started using MLPs in our portfolios. The same core assets that are contained with MLPs, namely pipeline and storage assets, are the same assets that originally came out of utilities and pipeline corporations. We have owned utilities and pipeline corporations in our portfolios at Miller Howard for over 20 years. What is the case for dividend-oriented MLPs today? And the answer is really simple: attractive yields that grow. Today, the yields on MLPs are about 6.5%, which is 3.5 times that of the market as measured by the S&P dividend, and over 100 basis points above investment-grade bonds. Also, MLPs historically raised their distributions at about a 6% rate per year, which gives them inflationary protection, and that 6% is well above the historical rate of inflation. Another advantage of the distributions is that they are tax deferred. They are a return of capital. The MLPs will provide you with a K-1 at year-end every year. The distribution growth is a function of new capital projects and/or merger and acquisition activity. These new assets generate incremental cash flows which create a stair-step type pattern to the distribution. Again, back to this idea of 6% growth per year. Lastly, the business model, by virtue of the contracts that the MLPs have with their customers, is very annuity-like. Also, those contracts have inflation adjustments in them, and therefore the cash flows also have inflationary protection traits. What are the cash flow generating assets of MLPs? They are pipelines, processing plants, storage facilities, all made out of steel. They will last a lifetime and are geographically monopolistic. A very important point, the monopolistic nature of the MLP cash flow generating assets. These assets handle energy BTUs, either natural gas, crude oil, or petroleum products. There are also dedicated pipelines that handle CO2. These long-lived assets provide essential services and are the BTU conduit, taking the BTUs from the wellhead to the burner tip on your stove or your furnace, and are the conduit literally from the producer to the consumer. Another way of thinking about MLPs is that you could describe them as utilities without walls. Or another analogy might be, think of them, a pipeline system as a toll bridge, or a storage system as a long-term contract parking garage. Again, a long-term business relationship creating annuity-like cash flows. Why are there these annuity-like streams to the assets that are managed and owned by the MLPs? And basically it gets down to the contractual nature with the MLP customers. Typically these are long-term contracts, 5 and 10 years, and many of these contracts have inflation adjustment clauses to take care of any potential increased inflationary cost, and therefore the cash flows and the distributions thereof are inflation protected. The MLP companies that we own really don't take title to the BTUs, and therefore there is not a commodity risk to the kinds of MLPs we own at Miller Howard. To the extent there is a risk, it has to do really basically with the customers of the MLP. Who are the other side of the contract with the MLP. And those customers are the likes of Exxon, BP, Phillips, Anadarko, Devon, very credit-worthy customers. So the credit risk really is not a factor in the MLP distributions or growth of distributions. Probably the most significant event for the MLP space in 2009 was the announced merger between Exxon and XTO. Exxon has probably been the most successful major multinational exploration and production companies, and like all the rest of the major companies, it basically abandoned the United States onshore exploration and production activity 25 years ago. The fact that Exxon today is moving back into the United States and will be spending their cash flow to develop oil and gas reserves in the United States is a testament to the future spending on the part of oil and gas companies that will beget the need for future infrastructures, projects that the MLPs construct, again, creating that stair-step up in cash flow and annuity-like nature of the cash flows. To summarize, why are MLPs a core sector for Miller Howard, and why are they attractive today? First, they have an attractive yield, that's 6.5%. Secondly, historically, that distribution has grown at about a 6% rate, and prospectively, we are looking for further 6% annualized growth. Thirdly, there is an attractive business model to the whole MLP structure, namely a growing annuity stream of cash flows, and therefore that growing stair-step annuity stream of distributions. Lastly, the distributions and cash flows of MLPs are inflation protected.